Hello, everyone, and welcome to Arka Venture Lab's first major digital event of the year. My name is Eric Benhamou. I'm the founding general partner of Benhamou Global Ventures, or BGV. BGV is one of three venture firms behind Arka Venture Labs. And I'm delighted to have a chance to speak to members of the entrepreneurial ecosystem of India. Today, as we begin 2021, I thought it'd be appropriate for me to share with you our outlook for the year. The key trends, business, technology, environment, that will influence how we think about investments and success for companies such as yours, particularly in the US markets. And to begin, I'd like to share with you a brief definition of who we are and what we do, so you have this in context and you understand our perspective. If you've been to our website, you've probably seen the phrase Enterprise 4.0. This is the overarching theme of our firm and our investment focus. By Enterprise 4.0, we mean this new generation of companies who are founded with AI at the core and new data sets, oftentimes proprietary data sets, from which they can extract new insights and generate intelligent workflows that result in fundamental improved business outcomes. In many cases, these companies are vertically aligned around vertical industry sectors. In many other cases, however, they help create this programmable cloud infrastructure that all of us, certainly cloud-native companies, have come to take for granted today, and they also help to secure this cloud infrastructure. Enterprise 4.0 for us is an immense opportunity because these full-stack companies are able to realize tangible business benefits in a relatively short period of time and are able to sell their solutions, which are complete solutions, into lines of business as opposed to central technology or IT administrations. So we feel that particularly conducive to generating venture returns. And many of you are CEOs of Enterprise 4.0 companies. The other dimension that you will find in our website when you visit BGV is this cross-border emphasis. We have a deeply held conviction that cross-border startups will have a better chance to win over fully contained US companies. They will have a talent advantage based upon the geography of origin, and they'll have a lower cost base that enables them to compete better. We learned about cross-border startups in the 90s when Israel emerged as startup nation and became rapidly an extremely prolific land of innovation. However, cross-border startups are not just reserved to small countries like Israel. We've also seen cross-border startups emerge from many other geographies, including Western Europe, with a strong emphasis on France in particular, but more and more India. We believe that these companies have a better chance to succeed. However, they do require a different kind of help, a different kind of nurturing. They expect us to help them build the team, oftentimes a cross-border team, with executives in the US, executives in the countries of origin. They expect us to participate in the creation of the appropriate go-to-market model. Usually the technology is already in place and working, but go-to-market, particularly after such a vast market as the US, is particularly challenging. Building a global brand, building partnerships that will help accelerate the growth of the company into this market, and also building the investment syndicates that will provide the capital depth required to really get the company to its full potential. These are the value-add steps which BGV takes with all of its cross-border companies, including the ones funded by Arka. Now, let me begin this discussion of key trends. And I'll start with something which we've now taken for granted as we're about to celebrate the first anniversary of the pandemic. E-commerce has now accelerated in such a pace that in just about 1 quarter, we've accomplished the same amount of growth as in the preceding 4 years. And we don't believe that this growth is reversible. In other words, we're truly on a different level, and the growth is only going to accentuate from this point forward. Of course, this was precipitated by the need that consumers had to buy groceries, medications, and just about everything online. But what we found is that this is not just reserved to consumer-facing businesses, consumer-facing goods and services. In the B2B environment also, suppliers, whether they're new or existing, the ordering process, the reordering process, all of this has moved to remote and digital. And this McKinsey research, which I referred to in the slide, described that this is exactly what customers want. What this tells us is that companies who have embraced this fundamental trend, which is not about to get reversed, but if anything, get accelerated, those companies who understand that interactions from this point forward will be primarily digital with their customers, these companies have a better chance to succeed and to build a winning business model. You've heard the phrase PLG, product-led growth. We believe that companies who understand and absorb this into their strategy will have a better chance to win, and they will retain our attention. Beyond e-commerce, we're very attracted to the fact that the DevOps phenomenon has taken hold beyond just the startup world, beyond just technology companies. Even legacy companies today have embraced a DevOps philosophy. This means, of course, continuous innovation, rapid innovation, continuous flow of changes all the way from the design to the operations to the delivery. And we believe that this growth is not only spectacular, but sustainable. However, it has led to a proliferation of tools which help span from the build phase to the test phase to the deploy phase and operate phase. However, we're seeing more and more an alignment of these tools and integration of these tools along platforms that enable DevOps companies or users of DevOps tools to basically rationalize their environments and utilize a set of tools which fit well together. So we believe that DevOps will require more and more tools, and that these tools will have to be better and better integrated between themselves and also across fundamental platforms. You will see many DevOps companies in our portfolio and expect that you'll see more in the future. As much as you see proliferation of tools in DevOps, you will see even more when it comes to martech. This slide is not an abstract painting or an abstract modern rug. It's actually a collapsed logo chart of some 5,000 plus martech companies who've been funded in the last 5 years. I believe today the count is even higher. 8,000 to 9,000 companies exist in that world of martech. As I mentioned before, customer interactions, customer journeys have to be tracked, understood, anticipated. And this requires very, very powerful tools. Unfortunately, many of these tools are narrow and they also need to be integrated. The reason I show this chart is twofold. First, clearly we're going to need more tools in that broad bucket of martech, because these interactions will be more and more digital, more and more complex, more and more sophisticated. But these tools will have to fit better together. You cannot expect a chief marketing officer to assemble a stack of 50 to 100 different tools, each one having to be tracked separately. So we do expect, as part of our outlook, that a few of these companies will emerge, much like in the DevOps space, and will start to consolidate other pieces of the edifice such that the tool set starts to make sense and becomes easier to deploy. And all of these companies who consolidate together will have significant customer synergies because they sell to the same individual, the same persona, through the same motion. and they sell related, oftentimes highly complementary products. When I described to you Enterprise 4.0 companies, I talked about intelligent automation leading to improved workflows, leading to business outcomes faster, sooner. Gartner has tracked what they call hyper-automation, which is their description of intelligent automation. And within that, they've tracked 4 core technologies which are at the center of their radar charts. The center of the radar charts refers to technologies which are very likely to be deployed in the next few months, less than 1 year. And there they identify AI developer services, as we just talked about when I mentioned DevOps, but also natural language processing, low-code, no-code platforms, and advanced computer vision. We believe that many Enterprise 4.0 companies will leverage these tools to create these new solutions. I want to mention also, next I want to talk about cybersecurity. Just a few weeks ago, the world became aware of what's probably the most ambitious and sophisticated cyber attack in history, the so-called SolarWinds attack, mounted by Russian hackers. This attack revealed a level of sophistication that is way beyond what most popular attacks had demonstrated in the past. But also, it revealed that an attack can be the result of an infiltration that took place months and months prior. The dwell time of these malware can measure months and years, which suggests that as cyber defenses, and this is true both for governments as well as private businesses, have a lot to catch up on. We believe that as a result, cybersecurity budgets will be reinforced, will be boosted, and this will create new opportunities for young cyber companies who are able to address this increasing needs of a much more robust identity and access management, threat analysis, threat detection, and threat remediation. Clearly, BGV will be paying close attention to this emerging generation of new cyber companies who will be responsive to the new threats horizon today. I want to switch gears a little bit and talk about some capital formation trends. Last year was a bit of a special year in the IPO market. Most of the IPOs that came out, certainly in the NASDAQ exchange, maybe not most, but a significant portion, were a different kind. They were SPAC IPOs, special purpose acquisition companies, which made it possible for private companies, through a combination with these SPACs, to become public themselves. This made the route to public status shorter, easier, more predictable, and created an appetite on the part of public equity investors that we had not suspected. Last year, $84 billion were raised in such a way, and we expect that these newly formed SPACs will now be chasing privately held companies and helping them go public probably 1 year to 2 years earlier than would have been the case using the traditional method. At BGV, we know a little bit about SPACs because we had a SPAC ourselves raised in 2018 that we used to de-SPAC one of our own portfolio companies, Great Dynamics, which is now trading on NASDAQ and has had a very strong year-end finish and is well poised to continue to generate value. And we believe that this route to becoming a publicly traded company is actually going to continue, perhaps not at the same surge level as last year, but we think that that SPACs, who in the past were little known instruments and oftentimes reserved to non-technology companies who didn't have what it took to really go public the traditional way, we believe that SPACs have now gained in credibility, in acceptance, and are becoming a new viable option for private companies to go public. And one of the reasons why that makes a lot of sense is because in the last 3, 4, 5 years, we've seen that publicly traded companies trade at a premium compared to privately held companies. This is a relatively new phenomenon, but it justifies why, despite the fact that private capital is plentiful, it makes a lot of sense for private companies who have reached critical mass to consider going public. Another phenomenon that I want to make sure you all understand is that last year was a bit different in the world of venture capital, certainly in the US, but I believe around the world. I'm showing you some trends here up to Q3 of last year, but the numbers for Q4 have just come out and reinforce what I'm about to say, which is, while venture capital as an asset class had a very strong year, raised to new levels. About $130 billion was invested by venture capital. More and more of that investments focused on growth stage companies and less as a percentage of the total on early stage companies. So again, more capital, fewer deals, and within these fewer deals, even fewer early stage companies. What this means is that for young companies, such as the companies that you are building at the moment, it is incrementally harder to find early stage capital. On the other hand, once you establish a base in the US and are able to demonstrate sufficient traction to qualify as a growth company, you'll have access to vastly larger amounts of capital that will help you cross the chasm and become really much more substantial. So this suggests that valuations will probably be more tame for early stage. Valuations for late stage will continue to go up. I want to finish this list with yet a different kind of trend that I'd like all of you to be aware of. I'm referring to the growing awareness behind ESG, or environmental social governance. Here you see a quote from Larry Fink, who is chairman and CEO of BlackRock, which is probably the biggest financial institution in the world, which owns a very significant chunk of all publicly traded companies, probably high single digit. So Larry Fink is basically saying that companies are more than just at the service of shareholders. They cannot ignore other stakeholders such as customers, employees, and the communities where these companies operate. It's a different concept of what a company stands for. And this is not just for large publicly traded companies. ESG awareness and ESG policies and practices starts even when companies are very young and certainly privately held. This is a trend that is particularly important for all budding entrepreneurs to absorb and integrate into the business. This is not a trend which is in conflict with business growth requirements. In fact, there is a strong correlation between strong ESG and good business outcome. Certainly, most economists believe that if you plan for good business outcome, you have to incorporate in your strategy, in your business model, sound ESG principles. That's certainly what we believe at BGV. And this takes particular meaning for companies who use AI. AI can be used for good purposes or bad purposes. AI has to be explained. AI models have to be explained. AI data has to be kept private, and the management of this data has to respect and be in compliance with regulations enforced in all the countries in which the solution is deployed. So being ESG aware and being ESG compliant is something that we as a firm will pay more and more attention to, not just within ourselves, but within our portfolio. Which brings me to my closing statements, where I believe that as the year unfolds, you're going to see more and more opportunities coming your way. We believe that there is a strong coincidence of favorable factors: strong technology trends, continued digital disruption appetite, plentiful capital, and a path to grow from a small budding base in India to becoming a much stronger global startup and soon bigger and bigger company with a path to go public. We certainly believe in that ecosystem. We think 2021 will be a very strong year, and we certainly expect to become your partners in that journey. Thank you.